Okay, so here's our financial planning topic of the day. You're not seeing me. You're just seeing me. So let me switch over to me and my Surface Pro. And I'm going to be looking down here, but this is our financial planning topic of the day. And the topic of the day is Roth IRAs and Roth 401ks. And this isn't what today's discussion is should it be Roth IRA or should it be Roth 401k? We're just going to talk about some of the basics because these things confuse some people. So this is part of the video where we split off another video. So if you're just watching this on YouTube, I'm going to ask you again, you can like, subscribe, and hit the notification button so that you're always notified of our updated videos. And this is a section when we're just spinning off the last 15 minutes or so of our weekly webinar. We're calling this the Financial 15. So you might see that 15 minutes to make changes in your retirement plan. So we want to give people an opportunity to go in and look at these segments and really learn something. And some of you want to be updated with all that stuff we talk about before here, the market updates. And there's, I think, very, very valuable updates from the slot group that we just went over. And if you're just catching this and you want to learn more about what happened in the markets last week and what our thoughts are about the market analyses and go over some of these retirement distribution pitfalls and things to watch out for and the things we learned from other people's mistakes, really, and updates from the best IRA group in the country, then go back and watch the rest of the webinar. But otherwise, we're going to dive into the Roth IRAs and Roth 401ks. Hopefully I keep it together here, and I'm going to move this down. So you should all be able to see my screen. I'll come back to that question I see here. So we're going to talk about Roth IRAs and Roth 401ks. So let's first talk about the Roth IRA. And I'm going to bring in, let's see, I've got this chart over here. So everybody can download these charts from our website. And I still have the 2022 charts up, which I tend to keep up until, it's pretty soon to now, probably mid-April, because people are still doing tax planning around the 2022 numbers, but soon we'll switch that over to 2023. But this is the retirement plan contribution limit chart. Let me just move the surface so we can see everything together. And the first thing we're going to talk about in the Roth IRA. Now, remember, IRAs and retirement plans are different. And when I'm talking about IRAs, I'm talking about individual retirement accounts. When you think about 401ks, 403bs, simple plans, SEP, IRAs, they're really retirement plans. The SEP IRA kind of runs the course of both, but certainly 401ks, 403bs, simple IRAs, they are retirement plans. And although they may act similarly, right, whether it's traditional and you pay tax later, or the Roth and you pay tax now and don't pay tax later, they are different and they have different rules. You've got to be very, very careful about that. All right. So with Roth IRAs, we have contribution limits. So there's a limit on the amount that you can contribute every year, and we're going to zoom in and see what they are right here. So these are IRA and Roth IRA contribution limits. And in 2023, you can see right here, your maximum contribution to a Roth IRA, or a traditional IRA for that matter, but we're focusing on Roth today, is $6,500 if you're under 50 years old. And once you cross that lovely threshold of 50, and it is lovely, you can add another $1,000 for a total of $7,500. That is the contribution limit. There, however, with a Roth IRA, there are phase-out limits. So what the heck does that mean? That means if you make too much money, you can't contribute to a Roth IRA. And yes, you can still do backdoor Roth IRA contributions if you're above this. And I have a video about that. If you search our library, I focus just on backdoor Roth IRAs. I want to say a few weeks ago. It could have been a few months ago. I don't know. But these are the current 2023, again, phase-out levels. Now, if you make $218,000, that's modified adjusted gross income, then there's a trigger there, and you can, and in this this $10,000 here, you can contribute less and less and less into your Roth IRA until once you're over $228,000, you're at zero for your contributions to your Roth IRA. So these are the Roth IRA phase out levels. So if you make too much money, you can't contribute to a Roth IRA. And of course, for single filers, it's worse because you really get slammed as a single filer. Your phase outs are $138,000, modified adjusted gross income to $153,000. So again, it starts to winnow down at $138,000, and once you hit $153,000, you can't contribute to anything. Now, so we talked about income, contribution amount. We talked about income. That again, we're under the Roth IRA here. Income phase out levels, right? If you make too much money, you can't contribute to the Roth, and what those phase out levels are. There's an income requirement to have a Roth, to contribute to a Roth. And we're talking about contributions here. We're not talking about conversions. Conversions are a different thing. But, and I'm going to write a note here so I can touch on that. There is an income requirement for contributions, not for conversions. That means you have to have earned income to be able to contribute to your Roth IRA. So conversion income doesn't count. People think, if I have taxable income, does that matter? No, it has to be earned income. So passive income doesn't count. Pension income doesn't count. Unemployment. No, I don't think unemployment counts, but if you have a question about that, deferred comp can, depending how it's structured. So deferred compensation. Or certainly, certainly if you take a package and you're paid out like a retirement package and you're paid out over a period of time, that can be considered earned income. So the income requirement isn't crystal clear. It's crystal clear in the rules, but it's not logical always. So if you have questions about the income requirement, you can ask. Contribution timing. So it's got to be by the tax filing deadline. Tax filing deadline for each year, it's April 18th this year, which means that you can still make a 2022 Roth IRA contribution if you meet all those requirements. You have earned income. You're not above the phase out levels. You can still make a contribution for 2022, and then you could do it also a contribution for 2023, of course, right now. Investment options. So Andy, I think it was Andy, was talking about, yes, you can buy gold in your IRA, even individual gold, and you can buy hard assets and things like that. There are some things you can't buy. I think antiquities you can't buy in a Roth, but really anything that you can purchase in a traditional IRA, you can purchase in a Roth IRA. I get this question a lot. Well, you're recommending a Roth conversion, but what can I expect to earn in that Roth? Well, you're going to earn whatever your investments earn, and you're probably going to invest the same way in your Roth as you did in your traditional IRA using the same instruments. I mean, you may invest differently, but any investments that you can choose in a traditional IRA, stocks, bonds, cash, mutual funds, ETFs, exchange traded funds, CDs, annuities, anything that you can invest in a traditional IRA, you can invest in a Roth IRA. There is a 5-year rule in that Roth IRA. So the 5-year rule says that you've got to be over 59 and a half and own a Roth IRA for at least 5 years before any growth or gains are able to come out tax-free. You've heard me say that this 5-year rule can be very confusing and very difficult under 59 and a half, but it's very, very simple over 59 and a half. I think I did a video about that, so I'm not going to spend a lot of time on that because we're comparing the Roth IRA and the Roth 401k, but there is a 5-year rule in the Roth IRA. And of course, there is no RMDs. There are no RMDs with a Roth IRA for your own Roth IRA. If you pass it to your beneficiaries, there are. We're going to talk about that. But there is no required minimum distribution. So a traditional IRA, if you have $1 million in there, your first year RMD, if you turn 73 today, would be about $37,000. But and let's just say you only need 20. Well, the IRS is still going to require you to take out that $37,000 and pay tax on it, of course. With the Roth IRA, there's no RMD. So if you want $20,000, you can take $20,000 out of there. If you only want $10,000, you can take $10,000. If you want to take your whole $37,000 out of there and spend it, you can. And of course, there's no tax on any of this as long as you meet that 5-year rule. And you pass. So not only is a properly timed and structured Roth IRA tax-free for you, but you pass to your beneficiaries, obviously zero tax. There can be RMDs if you pass it to your beneficiaries. So remember, if you've already hit your, with the Roth IRA, there are no RMDs. Scratch that for inherited beneficiaries. It has to be depleted by the end of the 10th year. And of course, zero tax. So you've got your 10-year rule. Glad I caught myself on that. Okay, so that is a Roth IRA. I hope that all makes sense. Roth IRA. Now let's talk about one of my favorite options here, and that's the Roth 401k. So I'm going to move this down here so we can see this. And let me clear some of this. What's going on here? Okay, we're just going to draw over it because it's getting all wonky, as they say. All right. All right, so the Roth 401k, here's your contribution amount for your 401k. Let's first talk about contribution amount. So I'm over here. Stop moving around. I'm going to make this a little larger. There we go. So here are our salary deferrals. So we contribute to retirement plans, not by writing a check and deposit, but it has to come out of your salary deferrals, right? So you can't just say at the end of the year, unless you have some time and you've got enough income, you can't just say, hey, deposit $30,000 into my 401k. You really have to plan that throughout the year. Now, some people will get to the end of the year, say the third quarter of the year, and they say, oh, I didn't put enough in. And now can you increase my contribution to the 401k? Now you've got to do a calculation to see if you can get the maximum amount in there. And you might be giving up all of your income for the rest of the year to the contribution into the 401k. So that is done via salary deferrals. So what are the limits for 2023? Under 50 years old, it's $22,500. If you're over 50, it's $7,500 for a total of $30,000. Now that's a significant amount of money that you can put into a retirement account. $30,000. And you think if you and your spouse are both employed and you both have a Roth 401k option, then you could be putting up to $60,000 a year away, and you'll never pay tax on the growth of that money again. Again, there is a 5-year rule. We're going to talk about that with a Roth 401k or Roth 403b. Remember, this isn't just 401ks, this is a 403b. So these are really valuable. If for some reason your employer doesn't have one of these yet, encourage your employer to develop one. They're not that expensive. If you already have a 401k, the 403b is really a non-issue. It's just an amendment to your documents, and it really should be included. Even the 403b, when I was a school board member at Council Rock, we had a 403b plan, not for us, but for the employees. So the employees had a 403b with a Roth option, and that should be commonplace these days. Now, there are the contribution limits. Let's slide back over here. So here are the contribution amounts you're allowed to do. Your income requirements, of course, are still there because they have to be payroll deduction. So what about the income phase out level? Remember we talked about the Roth IRA. It's actually right here, these phase out levels. If you make too much money, you can't contribute to a Roth IRA. But that doesn't exist. I'm going to make this red because it's more dramatic. That doesn't exist in the Roth 401k. So the Roth 401k, you can make as much money as you'd like, or as you can. You can make $1 million in a year and still be able to contribute to a Roth 401k. I hope you see the value in that, because if you make too much money, you can't contribute to a Roth IRA. But if you make over these phase out levels, if you make $230,000 a year, you can still contribute to your Roth 401k. That's why it's why if you have, I'm going to say it again, if you have a 401k plan, but you don't have a Roth option, encourage your employer, if you're self-employed, do it yourself. Contribution timing, I talked about, that has to be done really throughout the year because it's payroll deduction. So you've got to plan for this. You got to make sure it's right. Folks, I will share with you that this weekend I was going over our 401k, our company 401k, with my wife and I. So my wife's an employee. She has a 401k here. I have a 401k here. I was checking the contributions to make sure that we were maximizing our contributions, because the snapshot on the screen said one thing, but the contribution said another. So just like you, I need to check my 401k from time to time and make sure everything is working right. Investment options are a little different. You typically can't invest in anything you want. You get a menu of different investment options from the 401k provider, and you make a choice. You make a choice of what those investments are. Now, with some 401k providers, you can pay a fee to a manager to help you manage those 401ks, but typically you're responsible for making those decisions. They're also under the new, this is new. I'll come back to the 5-year rule. I'm just going to highlight this. This is new. There are no RMDs now from a 401k. Now that is new as of 2 months ago when the Secure Act 2.0 came out. It used to be that there were RMDs required from a 401k. Now that was erased. You pass the beneficiaries the same way. So the same way that the 401k is tax-free, follows the same rules. There actually can be a couple hiccups along the way with a retirement plan. So often it's better to roll that into a inherited IRA and deal with it that way. But be careful about this section here. The 5-year rule is very, very similar to the Roth IRA 5-year rule. However, it can be a little trickier. So we can, maybe we'll do a webinar about the 5-year rules with someone from the Slack group. So let's see if I covered everything. The moral of the story is the 401ks, let's see how small I can make this, but still readable. I'd love to do a fancy move and slide this up to the side, but I'm afraid that it's not going to go well. The moral of the story is Roth 401ks, Roth IRAs are very valuable. And yes, by the way, you can do both. So if you're under, let's say your adjusted gross income is under this phase out level, right? You're a married couple and you come in at $210,000. You're a married couple and your modified adjusted gross income is $210,000 for an example. You can contribute 100%, up to the max into your 401k. And you can contribute $7,500 and $7,500 in your Roth IRA. So a lot of people also believe that you got to do one or the other. You can't do both. You can absolutely do both. You have to pay attention to these phase out levels. Very, very important, because again, that applies to the Roth. The phase out level does not apply to the 401k. That is huge. So it's not really one or the other. Ideally, use both if you can. If you can't, if you can only contribute to one and you're a high income earner, you might want to look at the Roth 401k. But again, you got to make sure that you've got one in place, of course, and whatnot. Now, I wrote up here to remind myself this, it's a little small now. I wrote conversions, you remember. So conversions are, just to remind you, here's your tax-free bucket, or excuse me, tax deferred bucket. And here's your tax-free or tax advantage bucket. Conversions are a tool that allows us to move money. So you've got lots of money here. It allows us to move money from this bucket to this bucket. You pay tax along the way. Taxes due on the conversion. And then if you meet all the requirements, basically the 5-year rule, 0% tax on distribution. So the IRS allows us to convert as little or as much as we'd like to. You've heard me say that's a real gift. They could be very restrictive. They could put guidelines in, but they say you can convert all of this, or you can convert a little bit of it, or any portion in between that you'd like. The only thing you have to do is pay tax. So that is really easy with an IRA. You determine how much you want to pay. You figure out what tax rate you want to be at or you need to be at, and then you figure out the amount that switches over from tax deferred to tax-free. That's with an IRA. A Roth 401k is a little differently. So here's tax deferred 401k. and you've got your tax advantaged or tax free. So even if you have a 401k, Roth 401k option, and you've got lots of money over here. Now the IRS says you can convert it, but you have this thing called a plan sponsor or a plan custodian. The documents might say, no, don't allow for any conversions. They can put up a roadblock here that says, nope, can't do that, because they don't want to keep track of the paperwork and all that stuff. And sometimes they say, okay, you can do that, but you only get one. Very, very rarely do I see that they'll allow some great flexibility to be able to do meaningful conversions over time. So that is an area where Roth IRAs are, Roth IRAs are superior in my opinion than Roth 401ks, only because of the flexibility regarding conversions. All right, I hope that was helpful. So we went over the slot report. We went over some market updates. We went over the basic difference between Roth IRAs and Roth 401ks. This is really confusing stuff. I know. I hope I made it a little simpler for you. We have a couple questions. So let's see. Laxman writes, why aren't the banks competing with the treasuries in terms of offering higher rates? Let me come off of my screen share. So why aren't the banks competing with the treasury in terms of offering higher interest rates? Well, they are to some degree. So you can find CDs that are probably plus 3%. I think the banks are they have to make money, right? And that's really not the issue. The issue is that the perception or the comfort of safety in the U.S. government notes compared to the FDIC limits of the bank. But good question. Michael asked, Roth contribution limit if only one spouse has earned income. Great question. If only one spouse has earned income, you can still do $7,500. You have to earn at least this amount, right? With perhaps a bit more, but you can do a spousal contribution if I was unemployed and my wife was working only, and she earned $20,000 a year. As an example. Well, you might think that, well, she could do a Roth contribution, but I can't do a Roth contribution. But the law allows for a spousal contribution. So if we wanted to, she could do a $7,500 contribution for herself. She could do a $7,500 contribution for me. I only say $7,500 because we're both over 50. Under 50, you see the limits here. $6,500 for 2023. And I realize that you can't see my screen right now. Laxman also asks, what about income from an LLC toward a Roth IRA contribution? What about income from an LLC? Oh, the business income from your LLC? Yeah, that would count. For an IRA contribution. Depending on the structure, I suppose there could be a question there, but it should count. Walter says Roth 401k has RMD. It did, but not anymore, Walter. So up until the Secure Act, which was just a few weeks ago, there was an RMD required from a Roth 401k. Of course, you didn't pay tax on that RMD, but it was still something that needed to be taken. And again, you got to be careful. Retirement plans are different than IRAs, and their rules are different. All right, folks, it is the end of our hour here. I hope this was all helpful. I appreciate your attention and your time. Please remember to like, subscribe, and hit that notification button. And share this with your friends. If you think this is beneficial, share it with your friends. If you want to come by our class, particularly on Tuesdays and Thursdays, we have some room coming up at Holy Family. As I said, Saturday's getting a little full, but we'd love to see you. Look out for our upcoming events, and we'll talk to you next week. Have a great week. Take care.